Today, Kraken pays $30 million to settle with the SEC over crypto staking. Commissioner Hester Peirce breaks with the SEC's crackdown on those staking protocols, and we speak to the head of digital assets over at Goldman Sachs about the bank's blockchain strategy. Welcome to CNBC's Crypto World. I'm Jordan Smith. Crypto prices are plummeting in reaction to the latest crackdown from the SEC, and we'll talk about that in just a second. But as of noon Eastern, Bitcoin dropped by 1.5%, below $22,000. Ether tumbled by 3.5%, and Cardano slumped by 2.8%. Okay, let's talk all about the fallout from Kraken's settlement with the SEC. The crypto exchange is shutting down its staking service, which would stake customer assets in return for as much as 21% yield. On top of that, the firm agreed to pay $30 million in penalties. At the time of the settlement, the SEC claimed Kraken had about $2.7 billion in crypto assets and made about $147 million from the staking service. Kraken didn't admit to or deny the allegations when settling, and for the SEC's part, though, Chair Gary Gensler took the settlement as a chance to call out the broader industry, saying, quote, "Whether through staking as a service, lending, or other means, crypto intermediaries, when offering investment contracts in exchange for investors' tokens, need to provide the proper disclosures and safeguards by our securities law." Gensler also joined CNBC's Squawk Box this morning to talk about the agency's crackdown on staking.
It's not about the labels, it's about the underlying economics. And this really should put everyone on notice in this marketplace, whether you call it lend, whether you call it earn, whether you call it yield, whether you offer what's called an annual percentage yield, APY, that doesn't matter. If somebody's taking their tokens and transferring it to that platform, the platform controls it. And guess what happens if they go bankrupt? You stand in line at the bankruptcy court. There's a saying in crypto that says, not your keys, not your coins. So those other platforms should take note of this and seek to come into compliance, do the proper disclosures and registration and the like.
Now, this settlement hit crypto prices pretty hard, but Coinbase's stock also tanked after that story from yesterday that CEO Brian Armstrong raised his own concerns about the SEC's attention on crypto staking. In a thread on Twitter, Armstrong said he was hearing rumors that the agency was looking to ban crypto staking for retail customers, and added that it would be a terrible path for the US. He emphasized the importance of promoting development of crypto and Web3 technologies, saying it was a matter of national security. Coinbase has its own staking service called Earn, which accounted for 10% of the company's revenue in the third quarter last year. In response to Brian Armstrong's comments yesterday, that stock tanked by 14%. Now, not everyone at the SEC is on board with this new crackdown. Commissioner Hester Peirce voiced her dissent over the enforcement action in a letter on the SEC site. She called the agency's crypto enforcement paternalistic and lazy, and questioned whether a hostile regulator is best for the industry. She also said crypto offerings weren't making it through the SEC's registration pipeline, which calls into question whether SEC registration is even possible. All right, let's move on to our main story. While many of Wall Street's biggest banks have pretty much avoided investing directly in crypto, there has been a focus on integrating the underlying technology into trading and other businesses. Goldman Sachs is one of those banks. In fact, CEO David Solomon published this op-ed in the weeks following the FTX collapse, arguing that blockchain is much more than crypto. Well, Crypto World's Talia Kaplan spoke with Mathew McDermott, the global head of digital assets at Goldman Sachs, about the firm's strategy and what projects are in the works.
You lead the digital asset team at Goldman Sachs, so I want to start off by asking, what is your focus as you take on this evolving industry, and what's driving your enthusiasm in this space?
Yeah, very good question. There's a lot of things that we're focused on, but I would say thematically, for this year, there's probably kind of three real key areas. One, tokenization and digitizing the life cycle. So really using the underlying technology to kind of move forward, kind of the application for both our clients and ourselves. Looking to re-architect the kind of financial plumbing, which sounds very grand, but really just thinking how this technology can have a profound impact on the movement of collateral across the marketplace. And that really kind of encompasses a lot of kind of businesses like repos, securities, finance, derivatives. And then really thinking how digital money can have a profound impact on that and really kind of build out the adoption through enabling kind of greater liquidity across the marketplace. The excitement from our side is really, as we've spent the last 2.5 years building the team out and really starting to kind of develop our expertise in this space, seeing how this technology can impact many different parts of the financial system and have a real commercial impact. We're at such an early stage in terms of its adoption, but as you look across the marketplace and you see the breadth of financial institutions building out their digital asset teams, their digital asset strategies, be that, the sell side or the buy side, it's just super exciting. And I think there's a real recognition there. And I think probably the last point I'd make is, as the regulators have really come to focus on this marketplace, you've seen the Basel Committee, you've seen global regulators start to kind of really formulate regulations and provide just that bit more clarity in terms of what is possible. There's still obviously a long way to go, but that is just so helpful in giving people that confidence, to kind of continue to invest more and innovate.
What are some of the things that you're working on right now? I know you recently launched a tokenization platform that processed a $100 million Euro bond from the European Investment Bank, and CNBC was the first to report in November that you collaborated with Coinmetrics and MSCI to create what's called Datonomy, which you say essentially provides a framework for investment into the new asset class. Can we expect to see more things like this from Goldman? Do you have more clients for those digital bonds? And are there any other transactions currently in the works?
First and foremost, we were successful in launching our own digital asset platform in November. And as you rightly said, working with two other joint leads, SocGen and Santander, we underwrote a digitally native debt issuance to our own digital asset platform. And so that was kind of really exciting for a number of reasons. But the reason that we've really spent time developing our own digital asset platform is not so it's kind of proprietary to us. We're very eager to kind of open up and broaden that to many other kind of stakeholders across the market as adoption continues. But it's just allowed us to really expedite our own understanding and expertise and position us in a place for our clients where we can really kind of help with their own digital asset aspirations. And so kind of coming back to your kind of, one of your questions, what else are you working on? There's lots of different things that we're working on with clients, a lot obviously on the private side, but I think suffice to say, you've seen the market just generally across the globe coalesce around digital debt issuances. But as we look at kind of that application of the technology, there are obviously a lot of other markets where, potentially the commercial impact is even greater. So real estate is one that's always talked about. But even when you start to think about the fund complexes, be it money market funds, be it loans, and kind of the alts markets, for example, there's just many kind of different applications. And so as we've been very judicious with our resources, we're working on, 2 or 3 different projects across the globe. I think one of the things from my perspective that's kind of been quite important is really demonstrating that we can apply the technology across all the geographies. So we've done something in Europe, and as we continue to build out, we're very eager to do that, more broadly, as I say, across the globe.
I heard you say in a podcast in May that digital assets will, quote, bring about a paradigm shift in the financial markets and beyond. Do you still feel that way after everything that has transpired since then, most notably the collapse of FTX? Could that potentially take longer now? I mean, some industry insiders I interviewed said that they think this event will set the industry back a couple of years. Do you agree with that sentiment?
Yeah, it's a really interesting question. And I kind of think about it probably a little bit differently. And I don't necessarily would agree with the 2-year time frame. I think, there was obviously, there's been many implications of what happened last year. First and foremost, obviously, there's been this precipitous fall in the valuation of many companies related to kind of the crypto kind of marketplace. But really, the area that we've been focused on, blockchain infrastructure, we've seen, we continue to see some really interesting opportunities in businesses that are well managed and really kind of focused on what was the core foundational layers that will allow people, as I said, to really focus on that underlying technology to have a profound, positive, disruptive impact within the financial markets. And so as the noise is kind of, I guess, dissipated a little bit from the cryptocurrency market, it's allowed people, and particularly when you think about the regulators, they really now are much more knowledgeable about this space and very clearly delineate between the cryptocurrency side of the market and the application of the underlying technology. And that is, one of the byproducts, I think, of, the fallout from last year. And so that's allowed many of the traditional financial institutions who really are excited about what this technology can do to really kind of accelerate their focus without probably outside distractions. So So I feel that's kind of, a really good positive aspect of that. What I would say is also we do have a, crypto trading desk at the firm. We only trade cash settled derivatives, options, futures. What we've seen, and I think the CME and others have seen this as well, is a flight to quality. So we've seen more of our larger clients eager to kind of onboard and trade with, what they probably perceive to be kind of much better regulated and capitalized entities. So that, again, is been another byproduct of last year. And I'm probably just re-emphasizing one of the points I made and plays into an article that was featured at the end of last year. We do, and have made investments in the digital asset space, predominantly focusing, on blockchain infrastructure. So we are seeing some interesting opportunities there at valuations that just look much more sensible.
So a few weeks after FTX filed for bankruptcy, your CEO, David Solomon, released an op-ed titled "Blockchain is Much More Than Crypto," where he points out that the technology is already making Goldman's own work more efficient and can make the financial system more accessible. What would you say are some of the key benefits associated with the underlying technology of digital assets?
Yeah, look, I mean, firstly, I thought it was an excellent piece. And I think, we've seen others as well, I think, and Robin Vince and others kind of talk to this as well. I think the underlying technology really does, have the ability to streamline that value chain. So as you think about digitizing the life cycle and thinking about how you can reduce the number of intermediaries, reduce reconciliations as you think from inception right through to post-trade, there's the ability to enhance functionality. When you start to think about that intersection between digital assets and, say, ESG, there's some really interesting developments across the market. And that enhanced functionality that you get through the programmability of this technology really does kind of lend itself to that. And I think, really importantly, this technology also has a really profound impact on risk profile. This ability to have kind of settlement finality, and I guess this precision with which you can use key resources, particularly liquidity, it means you can reduce kind of key risks that kind of exist in the market today.
Okay, that's all for Crypto World this week, but we'll be back again on Monday, and we'll see you then.